Hey, greetings, everybody. Trevor Hall here with Mining Stock Daily. This is this week's long form episode we publish every Friday morning to get you into the last day of trading and into the weekend. It was a short week, but you know what? There was a ton of news out, a lot of corporate updates, important interviews. If you can go back to anything you missed throughout the week, you can go to clearcommodity.net, find the Mining Stock Daily podcast, and listen to all the episodes from earlier in the week. Two important segments here this week. First, we talked to my man, Tony Greer, TG Macro, the Morning Navigator, talking about the tactical position of entering the gold trade once again. He's coming off some big wins. We're going to talk about that. And then we're going to talk a little bit more about where we are with the sentiment and the fundamentals versus technical analysis and what he's seeing on the charts. And then our man Paul Harris comes back in, and he's joined by Ronnie Stoeferle. They just published the latest installment of In Gold We Trust. Great conversation with Ronnie, all about where we're at with the gold trade right now on a global scale. Really important conversation. Special thank you to Western Copper and Gold, Fireweed Metals, and Arizona Sonoran Copper for their continued support of the podcast. And as you can see, we're slowly moving into video. You can follow us on YouTube now. We're going to try to publish as much of this content as we can on YouTube in the weeks and months ahead. So it's a slow transition, in addition to also the audio medium that we've been known for the last 5 years. So that's enough for me. Let's jump into my conversation with Tony. Have a great weekend, everybody. We'll see you Monday morning with the morning briefing. Be well. Hey, everybody. Welcome into Mining Stock Daily. This is our first segment on this week's long-form episode here on the MSD podcast. Happen to welcome in an old friend. Before we do that introduction, let me tell you what Tony Greer's been up to. He was long tech when it was unpopular couple months ago. You could say that turned out well. And lately, he's going back into the resources sector, not just any resources. We're going to talk our favorite metal, precious metal. That's the yellow metal, gold, and talk about that a little bit. But TG, when you're not just crushing trades, I might add, you're also hosting the Oil Ground Up podcast for us here at Clear Commodity Network. So thanks so much for doing that. How are you, my man?
I'm great, man. I'm great. You know, the markets are offering opportunity left and right, and I'm just trying to stay on top of it as best I can. That's all I'm doing.
Well, you're killing it, dude. You're killing it.
We were fortunate, man. You know, it's sometimes the science works out, you know, and your process works out, you know, and the only reason that I'm not going to call myself a genius in any way, shape, or form, the reason that we got into technology is because the performance combined with the charts told us to do so. Right. And when the market says something is going on, you know me, man, you know, I listen. I have no ego, and I have I have not married to any single trade on the board, especially under these conditions. And it just feels like we're set up. You know, gold has backed off dramatically. It's backed off with yields backing off. I mean, we've seen gold back off with yields going in either direction. So I'm a little bit not concerned. I like the way that it's trading on its own. It's trading as its own story, and it's trading as its own commodity. And while I feel like, you know, all we did in that recent trade was when we got the NVIDIA news, that's an out for me, right? You get the big giant percentage move in one day. You've been holding on to this position for months, you know, and it goes from up a couple of percent to up 18, 20%, right? That's fine for me to say we're out and take that capital and look for the next trade. So, you know, the next trade could be, you know, I do like the miners here. I do like gold here. The things that I like about it, Trevor, are, you know, we've just seen a dramatic repricing in what I call the great rotation, right? So the great rotation was commodities over Qs, essentially. Right. And that last year, that was straight up and to the right last year. We just bought natural resources and sold tech all year. And then we had that rate reversal moment, or the sort of rate cycle reversal moment, I would call it, in March around the SVB blow up. And that changed things dramatically. That was where it all turned on its head. Rates started flying lower for the short term. and everybody just latched on to technology and pitched their natural resources. So when you see that inflection point at the very beginning of a rate cycle move and a couple of technical moves, you know that you're early, right? You know that you're early, getting into those technology names that are just starting to perform. And so that worked out. Now we have this gold story that I started to get back to a little bit incongruously, but I like constructively the way gold has been trading. For the first time in a while, there's been great price action in that last attack on the old high at 2070, right? Granted, we failed. We pulled back $100, not the end of the world. We're pulling right back into a rainbow of support, you can call it. Right. Especially to say PC, we can call it a rainbow of support. But we've got the moving averages rising up below the gold market now, right? So in my opinion, given that with everything else remaining the same, meaning the sort of conditions for gold rallying, I think that we can buy gold somewhere on this pullback. So gold somewhere into the moving averages around 19 and a quarter, 1900. GDX into the moving averages around 30, 38 down to 35, where we are now. And I could be wrong. We could, trade here for a couple of days and keep going south, and we'll see. But the way it lines up for me in terms of seeing like RSI and stochastics on this particular trade in both gold and miners after this pullback, everything lines up to the point where I put my money on the table, and if the dealer beats me, she can take my money.
Well, so before we pop into this gold miner trade, I do want to go back and kind of break open this technology trade a little bit and talk about where we're at now with that. So if you take a step back a couple months ago, when you were buying this dip back in March, and you mentioned the SVB, the beginning of this what was a banking crisis. We can have a discussion if that crisis is over or not down the road. Yeah. However, and I know you're a man of the water. You saw the surf rising. But you didn't actually understand how big of a wave you were catching on the form of artificial intelligence. No. And that's just part of trading, right? So you kept on riding that wave until the liquidity event gave you a solid out. And I think this is just an incredible textbook definition of how to trade.
Yeah, that one happened to go perfectly, Trevor. It's fair to say, right? And just to throw, to add some color to it, we got into Qs as the broad idea first of, okay, rates are going to change direction now from going higher to lower. That means technology's going back in favor. Now, this is me, dumb, rockhead, knuckle-dragging trader saying, okay, this seems like that's the next move. So that was the reflexive entry. And then I started seeing a couple of weeks of semiconductors perking up and putting in, several multi-sigma moves higher in a week and breaking through resistance levels. And I said, okay, let's have a side bet on that sector, right? And then you're absolutely right, because then I realized, and probably that was before the AI narrative was, blown up to where it is now, right? And the AI narrative now is like, bursting from your Twitter feed. Whereas in March, it was a conversation for sure, but it wasn't every other tweet. So that now it's every other tweet because the NVIDIA news is out. And so to go back into where we were, we surfed that trade that really never hurt us. It was, generating a couple of basis points of profits over short periods of time. And then, like you said, you got the headline, which for me is always going to be an out and thank you and not look back. Because that day of trading, a 25% move in NVIDIA, that was good for 4% in the NASDAQ and 12% in semis. And when you grind along, earning 50 basis points or 1% in a good day, and the market says, would you like an extra 12% on top of all that hard work you're doing for no extra work? There's nothing else to do, right? And sometimes, like we just had, I got run over for 3 days here, right? I admittedly sold the opening print so that I was free and I could look for the next thing, and the markets kept going higher. But that's not anything to complain about, right? That's a waste of time to complain about that. what you want to do is focus now and drill down on what to do with the proceeds, right? Let's not fuck that trade up, right? Let's make sure the next step is another good one into something that looks like tech did when everybody was throwing that out with the baby, like the baby with the bathwater, and suddenly the chart stopped going down. So there's a couple dynamics to pick up within that trade that were really, like you said, pretty textbook. And just the way that you want it to happen every time, God willing, and that happens once out of every 20 or 30 times. That you try something like that. So
so outside of the tape, if you're not looking at the chart, I want to ask you about fundamentals here. This really certainly seems like it was a textbook trade that we've seen over and over again in the last 3 years. And it seems like you were going back to that playbook. Hey, if it worked in 2020, 2021, it'll work now, because people have not forgotten that buy the dip mentality. And if there is this idea that the Fed is done, and many people will consider that being a pause would be closer to a pivot, why not buy tech on this dip? We've seen this play out. But
yeah,
could this be the last time that happens? Or is it so ingrained in investors and traders' mindsets right now, it's going to have to take a huge, and I'm going to pull this from you, Icarus print to break that demand, to break that mentality?
So do you mean, Trevor, I just want to be on the same page. Do you mean the mentality where the dip holds in technology and then reinvents itself and gets going? Is that what you're talking about? If this is the last time? Okay. So I do have a few thoughts on that, because that's an excellent trading thread to go on, right? Like, you're wondering, like, is there diminishing returns on, the idea of lower interest rates, meaning, get up and go for the growth stocks, right? And things like that. So I think of one dynamic that you maybe didn't include a little bit that definitely gave me confidence to be long the tech sector was that I haven't forgotten that we were still working our way out of the biggest negative sentiment bubble that anybody's ever seen. Right. So when we had stocks, when we had the S&P down at 3,600, 3,500 last fall, pounding away at the lows, we had max negativity. We had certainty that there was stagflation coming, and it was really bad scene for stocks. And out of that bubble came, the beginning of this rally that we're looking at now. So that's just one thing to consider there, right? How did we manufacture that bubble? We manufactured that bubble because of the Fed's brilliant or not way of managing market expectations, in my opinion. And I consider it somewhat brilliant because they get themselves out of what looked to be obvious pickles, where you would say, geez, they're handcuffed now. They can't do anything. If they do this and we get more inflation, they do this and the economy falls apart, right? Like, the Fed's screwed. Nonsense. The Fed is never screwed, right? The Fed can build in the expectation that they are going to fervently raise interest rates. Stocks go ahead and sell off. Data comes out that shows, wait a minute, maybe we don't have to fervently raise interest rates, right? We get a couple more CPI prints that are right in line to lower. Okay, now we have wait a minute, we don't have to slam the brakes on the economy with higher rates like this. And everybody that piled into that sentiment bubble that is now like, oh my God, higher rates, weaker stocks, S&P 2K has to happen. But it doesn't have to happen if everybody gets short looking for that and the data comes out and it changes the picture, right? Maybe the Fed has some idea, okay, I think we got inflation in line. If we keep the idea on the tape that we're going to continue to hike rates and inflation falls, guess what stocks are going to do? Guess what rates are going to do, right? So this is the way that I feel that they manage things sort of dumb as a fox. And when they're building in those rate hike expectations, they're maybe not as serious about it, or they know something that they may not have to raise rates that high in the future, and they let everybody pile in on the short side in stocks, and it changes the whole complexion of things. So those are some of the factors that I do think play into it and how the Fed manages that. So I will say, to come full circle to answer your question, no, I don't think that's the last time that we see this sort of impulse go from, negativity to consolidation to, okay, now we've got another craze pulling us out, right? We got the next craze is AI. Like, who knew it was coming? Who knew it was coming, that this was going to be the market's next religion? And by religion, I mean throw valuations out the window. This sell side shop just said the stock's going to 500. Last sale is 350. I'm a buyer.
Yeah.
Religion, right? I don't care. It's up $100. I see the price that I'm going to make between 350 and the analyst price target. Are the analysts ever right? No, they're never right. But this is the game that we play every time. So we got to see if this continues, because, man, I still get signals that there's a lot of money on the sideline because of the recent rise in rates. Family offices are burying money at 4% for as long as they can, and riding out some of this volatility and certainly uncertainty in the stock market. Christ, I mean, I don't know if I could tell you if the next 100 points in the S&P is up or down, or the next 500. I have no idea.
Well, your matrix is awfully short-listed now, and it has been for a little bit, and I've noticed in the Morning Navigator. I really hope people listening go read the Morning Navigator at least once, just to get a glimpse of, how Tony writes and communicates and what he puts out on that matrix. But it is, I would say, since you got out of tech here, it's about as short-listed as I've ever seen it in my 2 or 3 years of being a subscriber of yours. And I think that's a testament to just how volatile this market is. It could go almost either way, and there's hardly any clear signals of what's going to happen next. You keep on saying you're looking for that next trade, but you haven't told me, other than gold, because of the volatility behind the economy, you're having a hard time finding something.
Yeah, you're lockstep with me.
It's huge. Nobody knows.
It's visible, and that part of that is sort of conscious. The fact that my view matrix is down to 3 positions, quite honestly, to get it out in the open now, down from, what do I usually run, between 10 and 15, between 7 and 15 usually, which is the number that I'm comfortable with at a maximum when I'm trading, for myself. But that is truly, Trevor, a great observation, number one. And number two, this is a testament to me adjusting to nonlinear chaos, right? I tried the first 4 or 5 months of the year. I was trying to latch on to that trade for the rest of the year, right? That's always the game that I play, is trying to bet on the horses that are going to win in December, starting in January, right? Because I usually feel like by March or April, I know exactly how they run, and I know exactly how they're going to perform, right? And then what happened this year, we ran into that huge rate reversal mechanism that, took me from, thinking yields were going to explode forever to, oh my God, that was it. They're going down now, and we're going to go into an easing cycle.
It was somewhere in between there.
It was
somewhere in between there.
Yeah, and we're in between that. We're in between there trying to figure it out, where now the inflation impulse looks like it's coming back, right? And yields just won't back off for like whatever reason. And so now in trying to figure that out, I'm lowering the number of positions I have. I'm going to have them on for shorter periods of time, and I'm going to be in and out more, right? It's just what the market lends itself to. I've gotten better at adapting to that. So for another thing that's been helpful to guys in my Slack channel that I told a couple of months ago, I'm like, listen, like, I'm looking to, cut my longer term risk here. I'm looking to be sitting around with piles of cash available to trade situations that arise. And I'm talking about on a multi-day period. Mm-hmm. And I'm going to trade more. I'm going to trade more, I'm going to trade little pieces, and I'm going to trade more of little pieces. And when things go my way, instead of saying, look at this, I got it, I'm going to say, okay, sold. Now what? Right? Like that has been that adjustment already. And I've already doubled the frequency of number of trades per week that I've been doing. My performance is better.
Are you more comfortable? Are you more comfortable short-term trading?
Yeah. Yeah, I love it. Because I love waking up with fresh powder. I wake up with fresh powder, and, I can, without sounding too cavalier, you can find a situation that you want to dig into within 5 minutes of the opening using your Bloomberg. in the sectors that you like, the sectors whose charts you have memorized, knowing exactly where they are and getting a look at where they are in the opening. That's when all the dislocations happen in the first 5 minutes. And if you read the screens quick enough and react quick enough, that's where all the money is. All the real money is made positioning in the first couple of minutes of the day for what kind of day you think we're in for. Are we in for another day where yields are falling and tech is going through the roof and oil is going through the floor? I know how to trade that session. Are we in for a day that's a retracement of that, where yields are rising, the dollar is rallying, natural resources and metals are bid, and tech is falling over? I know how to trade that too. So it's kind of really addressing each day as it comes and deciding, what the speed of interest rates is going to do to the market, what the speed of the move of interest rates is doing to the market.
Yeah.
And that's generally how I'm kind of getting started off of, home plate in the morning.
Yeah. I want to ask you about the general commodity sector, but before we get there, I do want to talk to you more about your ideas on gold. I mean, both of them are behaving very differently. The general metals, commodities, and the monetary metals.
Mm-hmm.
And it's interesting, TG, because you've been long gold for a fundamental reason, and you've been that. You are just now recently looking at the gold miners, and I would assume that gold mining position is more of what you're saying, a shorter term trade, where your physical gold is, that's a long term hedge here.
Yes.
What are you seeing? What are you seeing here? If you maybe compare what you're seeing in the charts, technical charts of why this trade looks good, and opposed to the fundamentals behind what the price action of the metal.
Absolutely. I can speak to that for sure. I just want to put this chart up, Trevor, that I have been keeping a close eye on, and it is one of my personal Bloomberg creations that is GDX divided by gold.
Okay.
Right? So you just create a monitor like that, a security like that in Bloomberg, and you study that movement along with studying the gold chart and price action and studying metals and mining and price action, right? So this is just telling you how they're trading relative to each other, which has got strength, which is weak, etc. So, it's obviously a situation where gold miners are trading weak versus the metal, right? We've seen them trade much more dear versus the metal, to the point that they trade out ahead of the metal rallies, right? Right now, gold is banging on historic resistance levels at the highs, and gold miners are sucking wind 35-40% off of their highs, right? Or so, just broadly speaking, and everybody's like, what the flying flock is this? I think that becomes that's something that is really just a positioning phenomenon. I think when people are too long the miners, that they underperform, and not long enough in gold, that's when gold is going to outperform. It's hard to get traders to say, oh yeah, I'll buy gold here at 2050, 2070. Because if you're wrong, you probably have $100 route in your face, right? But if you want to look over at the gold miners chart and you look how far they've fallen, why they've fallen, in my opinion, it was very clear that gold miners were vying for leadership position on the year. If you remember, a couple of months ago, they were up 20% in line with tech stocks on the year and home builders, and that was the leadership. Everybody piled into them again. We formed a double top at 36 and collapsed 20%. Right? And now if you were in that trade and sort of carrying people through that trade, you're saying to yourself, on the second attempt at 36, while gold is trying to break through 2080, like, if it doesn't get through here, we are in for a major pullback, because gold is going to fail and pull back, and now we're going to have a double top in the miners, and they're going to pull back. Okay, so now I'm going over a lot of price action. The real thing to consider is that gold versus miners itself has gotten miners versus gold itself, they've gotten oversold. Right? Mm-hmm. So now I'm looking across my charts and I'm doing my scans on different time periods in gold and in gold miners. And in gold miners, I've got RSI down at 30, which is as almost as oversold as you see things get, meaning the sell-off is out of steam. The strength in the sell-off is out of steam. And I've got stochastics down at 4. And then I look over at the GDX to gold chart to see how oversold GDX is versus gold. And I've got even more oversold readings. Do you know what I mean? Like, are you feeling like the torque that could possibly be in this trade if you just merely have gold miners hold their own technical position and this miners versus gold hold its position and miners catch up? That's like a slingshot of strength behind the gold miners waiting to happen, in my opinion.
No,
and it's a short-term thing. It may only last for weeks or months, but I've also seen prolonged moves get shot out of, oversold conditions like this.
Yeah. And I'm just kind of curious, and maybe it's just a general question that it, in a sense, a general question that is a direction directly towards you, but could a bounce be more of a technical move based on the trading action, or could it be a fundamental reason why gold would go higher?
Well, here's my thing is the reason that this is when it gets deep into a trader psyche, and this may be uncomfortable for some people, but let's go into it anyway. No, the reason that I'm buying miners on this dip is because I demand of myself that I'm long gold and gold miners when gold goes blasting through 2080 and rallies $500. Right? I don't know. I don't have a crystal ball. I don't know that that's going to happen or whatever. That's what I think can happen. Yeah. And I think the odds of that happening are better than 50-50, that we go blasting through 2080 at some point, and keeps going for a $300 or $400 rally, a nice 10-15% follow through, maybe 20%. And I'm curious to see what gold miners will do when that happens, right? Because that sends gold into a new trading technical stratosphere, right? The double top in gold at 2080, that thing breaks after the huge range that we've seen since we formed that range.
Yep.
It's gone, like big time. So in my head, I've already got some gold. I've got some trading gold. I've got the safe gold, whatever. Let's have the miners on for that move and focus on it, because what if portfolio managers decide, you know what, gold 2100, this price I haven't seen. Why don't we chooch up our holders in the miners, right? This is historic. Gold's fucking flying away over here, and these stocks look cheap, right? That's what I feel like a first-day portfolio manager comes up with. If he's not trading gold, gold starts performing, and gold miners start performing like tech stocks for a couple of weeks. Right? Guy dials into that trade and says, bing, bang, boom. All right, I get this. Let's buy miners. They look cheap, because they are. Right? So
historically cheap. I mean, the last.
Yeah.
Okay.
You know better than me.
When gold. So this is about the third time gold's tested that 2080 mark and has been rejected. This last time it did it, gold miners were still just stuck in the mud. Like the second time or the first time they were gold was at 2080. Gold miners were about twice or triple the valuations at least than they were just last month when it tried that same move in the metal. And so it just kind of show you where sentiment even was recently with the gold miners. And I think you have to separate sentiment from the metal versus the miners, because one's very much risk off while the other one is incredibly risk on. So you've got to be very careful with, it's not a 1 + 1 = 2 type of situation.
I agree.
It's vastly different.
Yeah.
Let's see how this plays out. I'm sure you and I will maybe be chatting offline about whether that was a technical move higher or a fundamental move higher, depending on what the news flow is here. TJ,
yeah, man.
Go ahead. Sorry.
This is the reason that I wanted the reason I want to put this trade on, broadly speaking, like I said, is to be long gold and the miners for if and when I think when, not if, gold goes blasting through there. You know what? I'll leave it at that. We'll leave it at that. I was going to add another minor point, but it's not as relevant, I don't think, as the ones that I've made already. So,
all right. Well, let's talk about the other metals that are not necessarily performing well. And I've been out there, and I have expressed some serious concern about copper and the other base metals. Listen, TG, we got economic data out of China. Let's just say that China reopening doesn't seem like it's happening. It's going to take some stimulus to get that thing really moving again. They'll probably do it. That's what they always do. But here at home, Dallas Manufacturing Survey. Here's a couple quotes. Primary metal manufacturing, quote, business is slowing down. That is certain. Transportation equipment manufacturing. There is nothing encouraging on the horizon, end quote. Machinery manufacturing. We are seeing a massive slowdown in business activity. Does any of that sound commodity bullish to you?
Nah, man. Nah, and I saw you put that stuff out. I couldn't agree more. That's sort of like tumbleweeds sort of stories, you know, like in when you hear those stories from the merchants in the commodity markets, it gets especially concerning, right? The people that have their hands on cargo and have their hands on things like that, and they're like, yeah, we got nothing going on here, like no upticks in business. I will say that I wasn't predicate, like I would have totally agreed that we could see weakness in copper due to economic risk here and in China, et cetera, because I think, my whole basis on the metals bull side case is the transition to electric battery power, to EVs, and not as much due to cyclical forces, tailwinds from the economy. So when I hear the economic slowdown stuff, I'm like, yeah, but we could have expected that, right? We could have expected that with a sort of tempered view on the economy. We could expect to hear things like manufacturing slowdowns, transportation, shipping slowdowns. I get that. But when you hear John Kerry come out and say, like, we got to get to net zero by cutting out agriculture, I don't know, like, how we are going to contain food inflation at that point. I don't know how, that says to me, that's the signal that we are trying to re-accelerate the move, to carbon neutral, to electric batteries, to, creating less agriculture products, whatever the hell the World Economic Forum decides they're going to do to the planet, they're going to do. Right. And so there's not enough pushback, and there's not enough force or political will behind stopping it in any way. So that's the bull case for metals to me, right? It's that whole transition, and that is going to, unfortunately, swim upstream against cyclical economic weakness sometimes, and maybe more often than not in the next couple of months.
Yeah, it's going to be very interesting. I mean,
that's my read on it, Trevor, and whether it's right or wrong, I don't have another bull case. So that's my bull case. And when that story heats up alongside price heating up, I start salivating and I pile into the trade. And it hasn't been right. It hasn't been right for, since a couple of months, let's call it since before the, Russia-Ukraine conflict. Things were a lot different, right? And that was the market naturally putting upward pressure on gas prices. Right. And then we got the event that spiked them beyond anything reasonable. And everything from there was just to recede in commodity prices. So.
Yep. This is just screaming. It's just screaming recession to me, man. I mean, you've been through more of these cycles than I have. I mean, is there anything more obvious right now? Am I wrong to think that? I mean,
no, it's not. No, you're not wrong to think that we're heading toward that type of economic cycle, but don't think that means a down cycle in stocks, right?
Fair enough.
If we put it this way, I'm borderline in shock, like trader technical analysis vibrating at my desk, shock at the fact that yields have been able to turn back up north again. Right, when you saw that March 8th to March 13th reversal in 2-year yields go from 5% to 4% in 3 sessions, you're like, oh, that was something that I've never seen with my own eyes before. That's a reversal, right? Yields were just ticking higher it had to be 12, 15 months before that. And then that event, and you're like, got it, that's a reversal. I am still shaking in my seat here that yields have got the nerve to just recover their moving averages and bark back. So I'm trying to pick up what is the inflation that the bond market is pricing in that is not obvious to everybody in the market, because there's something going on. You know what I mean? Headline inflation stopped. Yet yields just went right back up to the highs of the recent range. And you're like, whoa, that's kind of odd without any inflation impulse at all.
Yeah.
So either there's no inflation impulse or there's one that I'm blatantly missing. And either that or there's one that nobody wants to talk about, which is, millions of migrants coming across the border that are going to, we're all going to be paying for with taxpayer money and eventually printing more of it to do more of that, et cetera, et cetera. So that seems like it's really inflationary to me, an open border with millions of people that we're going to pay for all of their healthcare, education, and housing costs. It's a big bill.
There's always a bull market somewhere. Could even be inflation, right?
Yeah, that's right. That's right. There is always a bull market somewhere. And thank God we have moves to make in the market to counteract some of the lunacy, or else it would be really, really dark in here.
Yeah. Speaking of dark, your office looks pretty dark. Thanks for turning on the light, man.
Yeah, no problem, man. I like to work in the dark, Trevor. I'm more productive with the lights off.
Let's not go there. All right, Tony.
No.
Hey, I appreciate your time. I love the hell out of you, man. Love the Navigator. You give
You're
us
the
some
best.
time at Clear Commodity Network doing the Oil Ground Up podcast about
My
once
pleasure.
a month. We've had a number of really good guests. We're going to continue to do that. I'm going to be reading you every morning. I recommend everybody listening also read you every morning. Have yourself a great weekend, my friend.
You too, Trevor. Thanks for having me on. You're the best, brother.
Hello and welcome back to Mining Stock Daily with me, Paul Harris. I have a very special guest today, and we're talking about gold in general, and later on gold equities. And I have great pleasure to introduce Ronnie Stoeferle, who's managing partner and fund manager at Incrementum, a Liechtenstein-based asset management company. Good afternoon, Ronnie.
Hi, Paul. Thanks for having me.
No, thank you. You've just published, or Incrementum's just published, its annual In Gold We Trust report, which has rapidly over the years become an industry benchmark piece of research looking at the precious metal space. This year's edition, over 400 pages of analysis, quite a read. I've been digging into it, and that's obviously informed the questions I'm going to ask you today, but I've got a lot more work to do because there's a lot of information there. But let's go back a bit first, Ronnie. Why did Incrementum start producing the In Gold We Trust report, and what's its aim?
Well, actually, I started the In Gold We Trust report when I was still working at the bank in Vienna at Erste Group. And I was always interested in, investing, and I made it through the dot-com boom and then the dot-com bust. And then I started as an analyst at Erste Group, responsible for international, especially Asian equities. And I had due to basically luck, somebody recommended a mining stock to me, which was Osisko Exploration, when it just started exploring Canadian Malartic, and I think they bought it from Barrick Gold for $80,000. And it turned out to be a 40-bagger, and that was a blessing, but also a curse, because I thought, well, this is pretty cool. It's easy. And so I went to my boss and said, hey, can I write about gold? And he said, yeah, go ahead, just do it, write a special report. And that was the first In Gold We Trust report. And, now 17 years later, I'm still writing the report. I'm still excited about the topic of gold, because it's actually not about gold, it's about everything surrounding gold. Gold is just gold, but the world changes so quickly. And therefore, I still love what I'm doing. I've got a fantastic team, and every year we try to write a little bit less, but we fail because there's just so much going on, and we just want to make, because I think there's quite a lot of doom and gloom. Everything will go to hell research in the gold space, and we want to make a sober analysis, especially also for the generalist investor, making a solid case for gold, what it does to your portfolio, why it makes sense to be overweight gold currently. So that is our mission, and yeah, I think this year's report, after many sleepless nights, I think we can be quite proud about the result.
Excellent, thank you. Interesting what your background and what you mentioned about Cisco exploration. My sort of background in the gold space is very similar. The sort of first thing I really got involved with was Continental Gold, which ended up being a very big win.
Yeah.
Okay, now this year's report is subtitled Showdown. Why is that?
Well, actually, we see three different showdowns in financial markets at the moment. First of all, there's the showdown between, let's say, central bankers and the real economy and also financial market stability. So it's not a dilemma; it's rather a trilemma that we're seeing. You know, they have to fight inflation, but then on the other hand, they don't want to cause a recession, and they have to guarantee financial market stability. So that's not gonna work from our point of view. But this showdown, where we see a recession on the horizon, and I think that's really our base case within the next 12 months. We'll hit massive recession, not a soft landing or a mild recession, but really a hard landing. So that's the first showdown. The second showdown is the geopolitical showdown, which goes hand in hand with the de-dollarization. It's a topic that we write about for 8 years now, but I think over the last couple of months it really became mainstream. So, you know, on Fox News, on CNN, the FT, they're talking now about de-dollarization. And obviously, you know, the fact that we saw a new all-time high when it comes to central bank gold buying last year. That's not a coincidence. It's just a consequence of the U.S. and the European Union freezing Russian currency reserves just with the stroke of a pen. So many, especially emerging markets, say, well, actually, we want to diversify out of US dollars, out of US treasuries, but we need something liquid, something with the tight bid-ask spreads, something that is accepted all over the globe. So gold is a natural choice. And the third showdown, obviously, is the showdown in the price of gold itself. We've been flirting with new all-time highs recently in US dollar terms, I have to say. And I think people often forget that gold made new all-time highs in every currency, but in US dollar terms. We made it on an intraday basis, we made it, but not on a closing basis. But I think that, you know, everybody only cares about the dollar price of gold. And as soon as we hit new all-time highs, I think there's going to be a new wave of investors coming in. For example, if you have a look at ETF demand, has been very sluggish. ETFs even sold last year. So I would regard them as the marginal buyer, and at the moment they're still on the sidelines. So, but I think as soon as we hit new all-time highs, FOMO will kick in, and we will see lots of institutional demand for gold again. And not just from a sentiment point of view, Paul. Did you attend Denver Gold Zurich? I think we didn't see each other there.
Not the recent one. I did the November one last year.
Yes. No, but that was like a couple of weeks ago, and you know, gold was I don't know, 50 or 60 bucks below its all-time highs. But it didn't really feel that way. So I think this kind of muted sentiment, this you know, people couldn't care less about gold. Um, in an environment where we are only slightly below all-time highs, I think that's a very positive sign from a contrarian point of view, and it just tells me that we're far away from a mania in the gold space. So those are the three showdowns that we describe. I think probably for the price itself, most important for the shorter term is actually, you know, this big question: when will the Fed pivot? When will they have to reverse their course?
Okay. Thank you, Ronnie. A lot to unpack there. So on some levels, it all sounds pretty grim, but as you point out, there's some good rays of hope there. I want to ask you to go into de-dollarization a bit more, because as you mentioned, the BRIC countries have increasingly moving in that direction. More recently, the Asian nations have said, you know, they're very much going to pursue de-dollarization. Um, this may be a naive question, but my question would be, if this all happens, great, but does Brazil really want a whole bunch of Indian rupees or Laotian kip? Or will de-dollarization mean that these countries use their own currencies and then immediately put that into something like gold, which they trust a lot more and have more confidence in?
Well, it's a good question, Paul, and I think that um, this is a process, and I'm not in the the dollar will completely lose its status overnight camp. I think it's a process that's going on for quite a while now. I think it's a process that definitely gained momentum over the last couple of months, definitely. But on the other hand, we have to ask ourselves, what's the alternative? Do the Chinese really want to have, open their capital accounts, make the renminbi float? I don't think so. Yeah, are their capital markets deep enough? So I think, first of all, we should differentiate between a reserve currency and a trade currency. I think that when it comes to the trade currency, quite a lot of things happened recently with so many bilateral agreements between the Saudis and the Chinese, for example, where they completely circumvent the US dollars and settle in renminbi or real. We've seen something similar with the big natural gas trade where they wanted to settle in euros. So there's quite a lot going on, but I think when it comes to reserve currency, it can probably take another couple of decades. So, but I think that it's no coincidence that it's mostly emerging market nations that are buying gold as a central bank reserve. It's quite a lot of actually energy exporters that are buying gold now. Actually, 3 out of the 10 largest gold buyers from a central bank point of view are big international energy exporters. So that's definitely a sign. And then I think, Paul, we should be, and this is something that I say quite often at my keynotes. I think we often think that the price of gold is dominated by Western market participants, but this is far from being true anymore. I think that's also the reason why we took a deep dive into the infrastructure of the Shanghai Gold Exchange, the India International Bullion Exchange. I mean, those numbers are just staggering. I mean, just China and India, they're responsible for 48% of global consumer demand. So they bought 1,600 tons just for the consumers. Then when it comes to central bank demand, I mean, India and China over the last 20 years, they imported like 34,000 tons of gold. So I think, if you have those numbers in mind and then also combine it with the natural affinity of those cultures, those religions for gold. And if you have in mind that, collectively, emerging markets, they are responsible, that's 87% of global population. It's 76% of global GDP growth over the last 20 years. They own 76% of global foreign exchange reserves. So I think those numbers are really staggering. And for us, being, from the, let's say, the Western world, from the developed nations, I think it's important to realize, well, actually, the gold market is more and more going into the East, into emerging markets, and therefore I think we should focus much more on what's going on over there than what's going on in our world.
Okay, thank you. It does tend to be a bit of quite a lot of myopicism in Western markets, Western focused, and nothing exists outside the Western sphere. Okay, and that presumably then feeds into, you talk about a new super cycle starting. And it seems that, you're very bullish on gold. There's going to be much more demand for gold, less of it available. A new super cycle is going to start. I guess the sort of $100 million question there is when? And when do you expect we will start seeing that?
Well, I would say when it comes, so what we did this year, Paul, is we introduced our incrementum recession model, and we said, well, actually, a recession is on the horizon, and there's, it's not our gut feeling, yeah, but if you have a look at M2 growth, being down on a yearly basis for the first time since the 1930s. If you have a look at the LI index, the leading economic indicator, if you have a look at the yield curve, the most reliable recession forecaster, basically, if you have a look at the labor market, which is cooling dramatically. I think it's a pretty easy call, actually, that a recession is on the horizon, and if you combine that with the market sentiment, we write that we only see pessimistic bulls, so everybody is expecting a soft landing or a mild recession, and that goes hand in hand, of course, with the hope that then there's going to be a pivot and everything is going to be fine, and my portfolio is going to go to new all-time highs. I mean, it's not that easy, actually. Yeah. So from my point of view, if you have a look at the forecasters questioned by Bloomberg, it's like those economists sitting in the 100 biggest financial institutions. Well, actually, out of 100, only 2 do see a hard landing. So a recession, a really nasty recession, is definitely not priced in. It's not the base case for the market. So I think once that happens, it will see a massive reallocation of capital. Now, what we did based on this assumption that we'll see a recession, we actually crunched the numbers and said, well, recessions have got different phases. So we came up with 4 different phases of a recession, and then just crunched the numbers and calculated what works best in which phase of the recession. And actually, gold is a pretty reliable recession indicator, recession hedge. So it works on average very, very well over the course of a recession. Equities tend to have headwinds, especially in the earlier stages of a recession. But then, once the reflation happens, and let's take a step back. What does normally happen over the course of a recession? Well, actually, we won't see like Austrian economics laissez-faire approach. Of course, there will be massive monetary intervention and there will be massive fiscal intervention. And I think this is what we described in our 2021 report. It was called Monetary Climate Change. And it basically said, well, fiscal policy is taking over. Politicians learned over the COVID crisis, and then it got confirmed recently with the energy crisis. Well, actually, they enjoy their status as the big spenders and delivering checks to the voters, and it works. They like it, and they don't want to give up this power that they have. So we expect much more fiscal stimulus. And that's definitely gonna move markets. So in the earlier stages, or in general in a recession, gold works well, while silver starts working only later on when the reflation starts. The same with equities. Mining stocks do have a hard time over the course of a recession, definitely. Yeah, so this should be some sort of a framework going forward for our asset allocation within our funds. We described this model quite in detail in the report, and I think it's a valuable insight.
Thank you. Now, in terms of all the fiscal stimulation, you sort of mentioned one of the things I pulled out is that the danger of government debt is underestimated. I mean, it seems like you think there's going to be an unpleasant surprise here in related to government debt.
Yeah, well, actually, nobody really cares about that anymore. It seems, yeah. I don't see, I don't see really that politicians here in Europe, obviously not, also not in the United States, although we have this next showdown when it comes to the debt ceiling. I don't really see that there's lack of emergencies, and obviously emergencies are always good reasons to spend more money and increase debt. So from my point of view, it is. First of all, we showed in the report that actually inflating the debt away doesn't really work. So we crunched the numbers on that, and it works if there's a inflation surprise. But once inflation is being priced in, then actually, it doesn't really work anymore, because quite a lot of payments are actually, how do you say, inflation. They are no. What's the English term for that? I'm sorry, I missed that. But
Priced
actually,
in, or
it's huh?
the inflation aspects are sort of priced in, or
Yeah, the inflation aspect is priced in, but actually, when it comes to quite a lot of spending, it is actually based on inflation. Inflationsanpassung. I don't find the English word. I'm sorry about that. But it is obvious that from my point of view, we are seeing, when it comes to debt, first of all, wars are always inflationary. Wars are always times when the debt levels are raised significantly. So this cost of the military buildup is clearly a strong driver. Unfortunately, then we're seeing an enormous amount of subsidies when it comes to green technologies, Green New Deal, however you want to name it, Inflation Reduction Act. I think it's actually going to increase inflation over the longer term, but it's a different story. So the debt levels definitely are something that just tell me, well, I don't see that those interest rate levels that we have, that they can be sustained. It just doesn't, the numbers don't add up. So at some point we will see some sort of Japanification of the world. I think a yield curve control will sooner or later be implemented, and I would be very much, how do you say, astounded if interest rates in 1 year from now wouldn't be significantly lower, significantly lower.
okay. Thank you, Ronnie. Let's sort of come around full circle and sort of talk about gold equities. You mentioned there's not a great deal of interest in gold equities at the moment. There is quite a lot of apathy. You can see this on the markets. A lot of stocks are trading at very low volumes. But you said, and you said that the market is ignoring the profitability of the gold miners. As you mentioned, the gold price is just $50 under its all-time high. Gold miners, they're getting their costs under control, so margins are expanding again. Gold miners are earning lots of money, but as you say, they're being ignored by the sort of broader market. Why do you think that is, and when do you think they'll start to receive some love again?
Well, yeah. I mean, the margins are stable. I think, cost inflation is under control, I would say. And then, of course, we saw that energy prices were coming down recently. Labor costs are also stabilizing. So I think I would regard that as an opportunity. But I think that over the last cycle, I think the miners screwed up big time with lots of useless M&A, and not being very cautious when it comes to the capital of their shareholders, or shareholder value in general. So I think they have to win or regain the trust again from financial market participants. And I don't really see generalists coming in. This is something that I talked about with Russell Napier recently. because I think that many gold mining companies will move more and more into the direction of copper, because copper is regarded as something positive, something green, while gold is always, it's got this, unfortunately, this kind of negative touch. Although from my point of view, mining gold is is actually pretty sustainable, because the emissions just happen once, and then you just have this gold for a couple of thousand years. But that's a topic of another discussion, Paul. But what I think is that we will see much more activity from gold miners moving into the copper space. I think the Newcrest deal already is confirming that thesis, because most of the growth that Newcrest has is in the copper space. But then, if you have a look at, for example, median operating margins in the commodity space, gold is doing tremendously well. If we have a look at the deleveraging that was happening in the gold space, very, very positive. If we have there's lots of charts about that in the report. If we have a look at free cash flows, if we have a look at cash levels, I think it's I would even regard it as a value play at the moment. And I think the fact that the large royalty and streaming companies like Franco and Wheaton, they're very close to their all-time highs. And that's already a sign that there is some interest in the mining space. So the next stage will probably hit the large gold producers. But when it comes to the developers, when it comes to the juniors, it's tough out there. It's really tough. There are really some good stories, and we've got a couple of charts regarding the reserves of the top 10 mining companies, and since the year 2011 they are down 33%. So they will have to compete for the very limited number of new large good deposits in stable jurisdictions. So I expect quite a lot of activity going forward, and therefore I think but I think it's gonna take a while, because for gold itself, we also wrote that I think the next couple of weeks could become really tough. I don't see the breakout really happening very quickly. Also because seasonality is pretty weak over the next couple of weeks. But I think it's gonna happen in late summer, early fall, and then I think that the mining space should do tremendously well, because from a fundamental point of view, the sector is really healthy at the moment.
So a message there is perhaps be patient. It is going
Yes,
to come. Yeah.
yes.
Excellent.
I think
Well,
patience
Ronnie,
yeah, is something that you need as a as a mining investor these days.
patience and high pain tolerance, I think. Yeah.
Yeah.
Excellent. Well, this has been a fascinating conversation, Ronnie. I really appreciate your time today. I do recommend that our listeners go onto the Incrementum AG website and download the report, either the full report, 400 pages. There is also an abridged version, which is about 50, 60 pages, all very good. Ronnie Stoeferle, Managing Partner and Fund Manager of Incrementum, thank you very much for joining us today.
Thank you very much, Paul. All the best to you and all listeners. And yeah, it's always a great pleasure. Thank you very much.
Well, thank you. And that's all from me, Paul Harris. Stay tuned for more from Mining Stock Daily.